Today, we are looking at a dramatic margin call cascade in Asian technology stocks. South Korea's Kospi index plunged 8.95% to close at 6,806.93, triggering circuit breakers twice. Global memory giant SK Hynix collapsed 15% in a single day, losing 340,000 won per share. This leverage shakeout has immediately spilled over, sending the Philadelphia Semiconductor Index down 4.78% to test key support. The panic in Seoul is driven by massive retail liquidations. Forced selling reached 142 billion won on July 9th alone, pushing the July cumulative liquidation to 344 billion won. Because forced liquidation data has a 2-day reporting lag, Monday's crash means the actual margin call damage hitting brokers will be much higher in the coming days. This Asian selling immediately hit Wall Street. The Philadelphia Semiconductor Index closed down 4.78%, threatening to form a bearish head and shoulders top. Because Samsung and SK Hynix dominate global memory supply, this margin call cascade in Asian technology is dragging down broader semiconductor valuations. At the same time, credit markets are signaling stress. Goldman Sachs trader Brian Garrett warned that technology companies are issuing bonds too fast and too cheap, with AI-related bond issuance hitting $75 billion in a single month. This flood has oversaturated demand and widened credit spreads, forcing companies to issue data center-backed debt using physical assets as collateral. Macro policy is adding to the headwinds. Federal Reserve Governor Christopher Waller delivered a hawkish warning, stating that if core inflation prints hot, the Fed could tighten policy in the near term. Waller noted he prefers targeting an inflation range of 1.5% to 2.5%, rather than a strict 2% target. Traders are now pricing in a 50% probability of a rate hike this month. Geopolitical volatility also flared up. Donald Trump proposed a 20% protection fee on all cargo transiting the Strait of Hormuz, warning of imminent strikes on Iran. Iran reacted sharply, warning that conflict will engulf the entire region. Kepler shipping data shows only 14 vessels transited the strait on Sunday, a sharp 60% drop from the prior week's average of 37. But these energy shocks might have a shelf life. Middle East producers are accelerating construction of alternative supply lines to bypass the Hormuz bottleneck. Led by Saudi Arabia and the United Arab Emirates, alternative transit capacity is expected to reach 14.2 million barrels per day by 2028, bypassing 62% of pre-war transit volumes and reducing the long-term impact of regional blockades. Beneath the AI hype, cyclical cracks are showing in equipment makers. Applied Materials revenue growth has slowed to just 3% annually over the last 3 years, and Teradyne's chip testing business is cooling fast as the hardware cycle matures. With ASML trading at a demanding 45 times earnings, these hardware valuations are highly sensitive to any capital spending delays. However, bulls argue that peak earnings fears are premature. Hyperscaler capex remains structurally supported, and major chipmakers are implementing 30% to 40% price hikes in the third quarter of 2026. Analysts project the broader semiconductor and memory cycle won't peak until late 2027 or early 2028, suggesting a significant growth runway remains. Disruption is also shifting from hardware to software. Meta released Musepark 1.1, a cheap and highly competitive coding model with a 1 million token context window. Meta's strategy is to monetize AI through massive distribution to its 3.5 billion users, rather than model fees, undercutting rivals and commoditizing the model layer. Faced with overstretched chip valuations, capital is rotating into software value plays. Adobe is trading at a historically low PE ratio of 12.8, presenting a compelling risk-reward floor ahead of its next earnings. Similarly, Alibaba is gaining traction as the cheapest AI play, jumping 11% on cloud acceleration and a U.S. legal settlement. We also have corporate earnings in focus. Big banks like JP Morgan and Goldman Sachs are expected to print strong Q2 results on trading volatility. Meanwhile, Netflix is combating declining subscriber engagement by exploring linear TV-style channels and Peacock bundles to sustain its ad-supported growth. As we look ahead, the combination of leverage liquidation, widening credit spreads, and geopolitical tolls represents a major stress test. While hardware pricing power remains strong, all eyes are on the upcoming TSMC earnings report on July 16th to see if fundamental growth can support these tech valuations.